Hey everyone, and welcome back. We're diving deep into the world of startup equity today.
That's right. We're going to unpack it all the good, the bad, and everything in between.
Especially after, you know that story that we talked
Yeah.
about that person losing like $100,000?
Oh, yeah. $100,000. That's a lot of money.
Yeah, from equity in a startup. So that's a cautionary tale right there. That's why we're here to help you guys kind of understand everything. We're going to be talking about stock options, RSUs,
Liquidation preferences.
liquidation preferences. Don't even get me started.
People don't talk about those enough.
No, they don't, but that's where you can really get burned.
Definitely.
So let's start with the basics. What exactly is equity compensation?
So, equity compensation is when a company, usually a startup, gives you part ownership of the company. Instead of just giving you a straight salary or a bonus, or sometimes in addition to, they'll give you a piece of the company.
Hmm.
So it might be in the form of stock options, which is a right to buy the stock at a certain price. Or it might be RSUs, which are actual shares of the company that you'll get over time.
Okay. So you basically just explained two of the big ones,
Yeah, two of the most common ones.
stock options and RSUs. So how do you know if an equity offer is actually a good deal? It can't just be about the number of shares, right?
No, definitely not. I mean, you could have like a million shares, but
Yeah.
if the company's only worth $1, that's not going to mean a whole lot to you, right?
Right.
So it really depends on the terms of those shares. So you have to look at things like how many total shares are out there. Because, if the company is constantly issuing more and more shares, it's kind of like diluting your piece of the pie. And then there's also liquidation preferences, which determines who gets paid first if the company's sold. So if the company sells for a certain amount, but there's a group of investors that have these liquidation preferences, they might get paid before you see a dime.
So they're basically cutting in line.
They're basically cutting in line. They get their money back first.
Okay, got it.
And then, of course, you have to consider the likelihood of the company actually exiting, going public or being acquired.
Right, because I mean, that's how you're going to make money, right?
Yeah.
It's not like you can just go and sell your shares to anyone whenever you want, can you?
No, not unless it's like a publicly traded company like you see on the stock market. But with a private company, like a startup, those shares are illiquid, which means it's really hard to actually sell them and get money for them.
So basically, you're just holding on to them until, hopefully, one day the company's sold or goes public.
Exactly. It's a long-term game.
So even if a company is doing really well,
Hmm.
are you saying you might not actually see any return on your equity?
You might not. That's one of the big risks with equity.
Okay.
I think one study said that almost 40% of employee stock options actually end up underwater.
Underwater, what's that mean?
It basically means that the company's valuation has gone down
Oh, okay.
and your options are now worth less than what you would have paid for them.
Okay.
So it's kind of like if you bought a house and then the housing market crashed,
Right. Okay.
your house is worth less than what you paid for it.
So then they basically just become worthless.
They might. It depends on if the company can turn it around or if they're acquired for a price that at least gets you back to even.
Got it. So what about those liquidation preferences? You were telling me about those earlier.
Yeah. Liquidation preferences are a really important thing to understand when you're looking at an equity offer because they can really determine how much money you actually end up making, if any, if the company's sold.
Okay.
So let's say a company sells for $10 million,
Okay.
which, sounds like a lot of money.
Yeah. Sounds
Mhm.
pretty good.
Sounds pretty good, right? But imagine that there are these preferred shareholders that have something called a 2x liquidation preference.
2x. What's that mean?
It means that they get paid twice their investment amount before anyone else gets paid.
So if they invested like $1 million, they get 2 million back.
Exactly. They would get $2 million back before any common shareholders, which are usually employees, see a dime.
So in that case, if the company sold for 10 million and they've got the 2x liquidation preference, that 2 million comes right off the top.
Exactly.
So you're left with like 8 million potentially to be split among everyone else.
Yeah, potentially.
And that could be a lot of people.
Yeah. And depending on how much money they invested, there might not be anything left for the common shareholders.
So even though the company sold for 10 million, you might not see any of that money.
Yeah, that's the risk.
So what are some of the strategies that people can use to mitigate these risks when they're considering equity compensation?
Well, I think one of the biggest things is diversification.
Diversification. So don't just put all your eggs in one basket, especially if it's a risky basket.
Exactly.
So even though it's tempting to like go all in on your company stock, especially if you're really excited about it and you believe in the company, it's wiser to kind of spread that risk around.
Yeah, absolutely. I mean, think of it like your own personal investment portfolio, right?
Okay.
You don't want to just put all your money in one stock no matter how good it looks.
Right.
You want to diversify, you want to invest in different types of assets, different industries to kind of balance out the risk.
Makes sense. So what else? What else can people do?
Well, you also really want to make sure you understand the company's financial health.
Okay. So kind of do your due diligence.
Yeah, do your research.
Look at the financials.
Look at their funding history, look at their revenue growth, look at how they're doing compared to their competitors. Are they the leader in a really fast-growing market, or are they kind of struggling to keep up in a really crowded space?
Okay. So it's not just about understanding the terms of the equity offer. It's also about kind of like doing your homework on the company itself.
Yeah, you got to do your homework.
What else? Anything else people should think about?
Oh, one more thing. I think it's really important to seek professional advice.
Okay.
If you're serious about taking an equity offer, it's probably a good idea to talk to a lawyer who can help you understand all the fine print in the offer,
Definitely.
and maybe also a financial advisor who can help you figure out, how does this fit into your overall financial goals and plans?
Got it. So talk to a lawyer and a financial advisor. They'll be able to help you navigate all of this.
Exactly.
Well, it's been great talking about all this. Equity compensation can be a really powerful tool for building wealth,
It can be.
but it definitely comes with some inherent risks. So making informed decisions is absolutely key here.
Definitely.
As you guys continue your own research on equity compensation, here's something to think about. What are some of the non-financial factors that might influence your decision? So things like company culture, the company's mission, those kinds of things.
That's a good point.
Sometimes the opportunity to be a part of something meaningful can actually outweigh the purely financial considerations.
Absolutely.
That's it for today's deep dive into startup equity. We hope you guys feel more empowered to make informed decisions about your own financial future.
We'll see you next time.
See you then.